Hello and welcome to another episode of the Finrestra podcast. I am Jan Muschult. I'm doing this emergency recording of the podcast because today is Wednesday the 15th of March and I'm recording this at about 3:30 p.m. Central European time. And the reason I am so specific is because European bank stocks are down a lot today. So, for example, Credit Suisse is down about 25%, and also stocks of large European banks like Deutsche Bank and BNP Paribas and SocGen are down about 10%. So, what's going on? As a quick recap, last week there was the failure of the American Silicon Valley Bank after a bank run. And it seems that the panic among investors has now moved on to Europe. Although, as I will explain in this podcast, there are some very large differences between the European banks and Silicon Valley Bank. So, just as a reminder of what happened to Silicon Valley Bank, in 2019, the bank had a lot of inflows of deposits from venture capitalists and startup companies. And at the time, interest rates were very low, and bank management decided to invest that cash in long-term bonds with a fixed yield. So in order to make some interest income, they bought bonds. Now, of course, to fight inflation, the Federal Reserve has raised interest rate with the consequence that bond prices went down. And actually, if you looked at the market price of the bonds of Silicon Valley Bank, the bond prices went down and almost all the equity was evaporated. And that's a very unstable situation. And then what happened last week was that a lot of venture capitalists and startup companies decided to withdraw their deposits from Silicon Valley Bank. So they wired their deposits to other banks. As a result, Silicon Valley Bank needed a lot of cash. They had to sell some of their bonds at a loss. And ultimately, the outflows were so big that their operations had to shut down. So obviously, given today's price action, the question is, can something similar happen in Europe? And I think there are two very large differences. So first of all, Silicon Valley Bank had a very specific clientele. So as the name implies, it's mostly working for these VCs and startups in Silicon Valley. And on the other hand, like the deposits at European banks, for a large part come from retail people who have a deposit guarantee, which is not something that the depositors at Silicon Valley Bank had. Although I should say that now the Federal Reserve or some American authorities have also extended the deposit guarantee to deposits over 250,000 US dollar. So, but a first difference is between European banks and the SVB is that European banks should have a much more stable deposit base. And the other big difference is that while Silicon Valley Bank had more than half of its assets in long-term bonds, if you look at the balance sheet of a typical European bank, the bond portfolio is maybe 10 or 15 or 20% of the assets, but nothing compared to SVB. So even if bond prices do go down following higher interest rates, this won't have a major impact on the liquidity position of banks. But there's something else that's very different between the US and Europe, which does deserve some attention. So in order to deal with outflows of deposits, banks need to hold high quality liquid assets, and those mostly consist of cash, but that's not like cash like in euro bills. but mostly that's cash that's held in deposits at the central bank. And that amount of cash has gone down in the last couple of months due to actions by the ECB itself. So for people who have seen some of my videos on YouTube, you might know that banks could also borrow money from the ECB. And they did that at a time when interest rates were very low. But in order to fight inflation, the ECB has raised the interest rate on those loans as well. And so if banks have both money deposited at the ECB and they have borrowed money from the ECB, it doesn't make sense to hold both at the same time while they are paying the same interest. And so a lot of banks have repaid billions in these TLTRO loans, the TLTRO loans from the ECB, in order to reduce their interest payments to the European Central Bank. But of course, to do that, to make the repayments of the TLTROs, they used their deposits at the ECB. And so because the deposits have gone down a lot, it also means that the high quality liquid assets of European banks have gone down. And I guess some of the explanation of today's price drops in market cap of European banks is due to the fact that some investors started worrying about the liquidity of European banks, and then they looked into detail and they saw that suddenly, or compared to a couple of months ago, the liquidity ratios of European banks have gone down a lot in the last quarter. But as I said, that's just because banks have repaid a lot of the TLTRO loans. So it's not really something to be worried about. So to summarize, European banks still have quite stable deposit base. The price drop in market value of bonds doesn't have a lot of impact on the liquidity position. And the reason that banks have less liquid assets today compared to September of 2022 is because they have repaid a lot of their loans to the European Central Bank. But I should also stress that even if banks were to repay 100% of the TLTRO loans, they would still have collectively about 2 trillion euro in deposits at the ECB because of past quantitative easing. So if there are some liquidity issues at European banks, it might be concentrated in a couple of countries, especially Italy, because their banks had collectively borrowed more from the ECB than they had deposits. But I think as of today, liquidity positions are still comfortably above what the regulators require. And otherwise, banks would not have repaid that many loans to the ECB in such a short time. Now, just as a final remark, so of course, Credit Suisse is not a euro area bank, and it's dropped most of all major European banks today. And that appears to be due to some comments from a Saudi investor in Credit Suisse that they wouldn't inject any extra capital into the bank. But I think after the recapitalization, Credit Suisse still has plenty of equity and liquidity. So we shouldn't be too worried. It's mostly panic on the markets. But according to my analysis, banks still have enough capital and liquidity. And so it seems that today's price action is an exaggeration. So as long as the ECB doesn't do anything more stupid, banks should be fine. So this has been an emergency episode of the FinRestro podcast. As always, you can find me on Twitter where I'm at Jan Muschot. So that's at JANMUSSCHOOT. Or you can also connect with me on LinkedIn. Thanks for listening. Until next time.